This is INBrief with Alistair Jones, Senior Managing Director at Leadenhall Capital, all the way from London. So first of all, Alistair, it's a great pleasure to welcome you to sunny Noosa, and thank you for coming all this way to participate in the Investment Leaders Forum.
Well, thank you for having me. It's such a lovely place.
Insurance-linked securities, Alistair, they're getting better known in Australia, but they're still, you'd have to say, under-owned in wealth portfolios. What do you think makes the opportunity in insurance-linked securities especially relevant and even compelling today?
Well, from the start, I mean, they're very diversifying. They're something very different to other assets in a portfolio. And maybe if people don't know what they're about, these are bonds issued by insurers, normally property insurers, and lots of insurance premiums support the coupons. So you are subject to property risks like floods and fires and winds. That's pretty diversifying to other, things going on in markets. So less affected by economics, the economic cycle, downturns, recessions. And so if you're worried about the economy, oil, inflation, geopolitics, private credit, whatever else might be going in the world, this is a good place to be to shelter from that, and it offers you a really good yield at the moment of around 10%, cash plus 5%, something like that. So a lot of value, I think, in portfolios.
Given that turmoil you're mentioning, Alistair, a lot of advisors, they would say you had me at low correlation, but what does low correlation actually mean? How does it work in insurance-linked securities in principle?
Yeah, you're definitely getting a different pattern of returns. So if you get a recession, an economic downturn, equities typically fall, corporate bonds fall, property falls. This keeps chugging and keeps giving you your coupon supported by those premiums. So it is a different pattern and that low correlation of return. But you should just be aware it does come with some risk as well. It comes with insurance risks if you get those types of events. But they typically happen at different times in markets. So, it's just valuable to investors. And, in the current market environment, when yields are high for various reasons, but investors are valuing it. As you say, they have been underappreciated in wealth portfolios. They've been in institutional portfolios for a long time. The Australian supers, the Canadian Maple 8, the big pension funds of the world in the UK, US, Japan. But they are getting more and more into wealth portfolios now, and wealth managers are seeing the opportunity there.
Clearly, it's based on insurance. Is that the absolute number one key risk that advisors need to understand before allocating to insurance-linked securities? Are there others? And in what other ways do investors get the asset class wrong when they look at it?
Yeah, that's a really good point. I mean, there are different risks. They are insurance risks, and we typically support natural catastrophe type risks, but there are lots of other risks that insurers take on. It could be, cyber risk, casualty risk, war risk. These are all of human type risks and a bit harder to model. We going to keep it a bit simpler and focus on natural catastrophe events that we think are easier to model. There's hundreds of years worth of data there, and we can get a lot of comfort in modeling in that way. But they are insurance risks. And like any other asset class, you can target risks and return all the way up and down the spectrum. So, if you're an advisor, you should try and target the risks that's right for you. A good entry point are liquid tradable cat bonds or catastrophe bonds. And that's easy to come in and out of that asset class, and they're pretty low risk as well. But you should get comfortable with that risk. But if you are more comfortable, you can dial the risk up, or you can actually dial it all the way down as well. But over the long term, cat bonds have given you a Sharpe ratio of something like 1.5, which is really good. If you go more senior, you can actually get Sharpe ratios closer to 2. And at the moment, that yield of 10% as well is a good indicator of the returns on offer.
Alistair, we've seen some scenarios in the last couple of decades in which all correlations tended to 1. Has that been the case with insurance-linked securities in those big crises such as GFC and COVID?
That is a really good example. So you can by chance get some correlation. So in the GFC, I think everyone probably remembers equities are down 40 or 50%. Here, cat bonds were down less than 1%. So you can get behavioural factors. If some people are just selling all their assets indiscriminately across the board, you can get some behavioural aspects, but we think that's a good result. I think ILS was down 0.7%. I mean, that's pretty much flat. And that you see that fundamental driver of return is something completely different. But you can by chance get these events, but by and large you don't.
Across your career in funds management, Alistair, what's the best piece of leadership advice you've ever received?
You just do the right thing for the end investor. Discuss issues and funds and investments that are right for them. Don't try and push them a product that you want to sell. Listen to them. Act with integrity. Act with authenticity. That way you build a relationship. They'll come back to you if they want advice again in the future. If you just push a product at them, that's very transactional, but you probably won't see them again.
Alistair Jones of Leadenhall Capital, again, a great pleasure to have you here at the Investment Leaders Forum, and thank you for your time today.
Thank you.